Yesterday, the BMO and the Scotiabank released their quarterly report. Scotiabank they announced they increased the dividend again. If you go to Scotiabank's website, you will find all the common share dividend history. You can see from 2015, the dividend was 66 cents, and today it will be 85 cents. So normally they increase the dividend twice a year. And Scotiabank has a very long history about the dividend payout. Actually, the first dividend they paid is in 1832, is more than 100 years ago, and they actually never stop. This is really amazing. Okay, if you click on this link, you can see the whole history of the Scotiabank dividend since 100 years ago. Someone asked me a question: why I select TD Bank and Royal Bank before Scotiabank. So basically, why I want to invest more money in TD Royal, not in Scotia. First, Scotia is still a good investment. I mean, it's a good blue chip stock. It's not like it's a bad stock I don't invest. The reason I select TD and Royal before Scotia, we can look at some numbers here. For example, for the last 5 years, this is a TD Bank's investment return. It's about a 16% annual compound. And the Scotia is less than 10%. And I also checked the dividend history on both sides, the TD Bank and the Scotiabank website. In 2015, Scotiabank is 68 cents, and today is 82. Right now is 82 cents per quarter. In 20 years ago, in 1998, it was 25 cents. At TD Bank, in 2015, it was 51 cents, and today is 67. And 20 years ago, 1998, it's 8 cents. Obviously, in the last 20 years, TD Bank has a much higher dividend growth rate. According to the document available at the website, you can see TD Bank, the dividend growth rate is about 11% annually. I want to think about what does it mean 11%. I mean, for example, in 1998, the average typical middle class salary may be around $50,000 a year. Let's say that if you can get 11% increase every year, then today your salary is $400,000. This could be maybe the top 1 or 2% in Canada. So yeah, when you think about the growth rate, you have to think about the compound interest. So compared to TD with the Scotiabank, the TD Bank, the business has a much higher dividend growth rate and they also have much higher profit growth rate. So you can say TD, the business is more profitable than Scotiabank. This is basically this is the main reason why I would select TD and a Royal Bank before Scotiabank. Royal has a very similar performance as TD Bank stock. Charlie Munger at one time he mentioned in a speech, actually it's the art of the stock picking. He said, over the long term, it's hard for a stock to earn a much better return than the business, which is underlying it earns. If the business earns 6% on capital over 40 years, you hold it for 40 years, you are not going to make much different than a 6% return. Of course, this is a long-term investing thinking. But when you look at the market valuation, for example, go to the morningstar.ca, you can see Scotiabank. The Scotiabank's valuation is below industry average. Is always below industry average. This is 5 years, so it's always below industry average. Then if you look at TD, it is always above industry average. What's the reason? Because these two companies are one of the biggest company in Canada. So it's not like a small company, the price jump around. Why the whole market always give a higher valuation to TD and give a lower valuation to Scotia? They are both in banking business, almost the same, exactly the same business model. Why their valuation is different? TD seems like always 20% higher than Scotiabank. This, if you look at what Charlie Munger's opinion about investment, then you will realize you will understand what's the reason why overall the market will give 20% more valuation to TD, which has a much higher growth rate. But from my experience, and most average investor, they actually will select Scotiabank before TD and Royal. The reason is also simple, because if you look at the valuation, Scotiabank has a lower valuation, and also they are more diversified. I mean, from a business perspective, they are more diversified compared to TD and Royal. Most average investor only can think about maybe a couple quarters or 1 or 2 years. But the real investor, they always think about 5 years, 10 years, 15, even 20 years. So because they have a much longer, the time frame to think about investment. That's why the experienced invest and the average invest, they have a completely different opinion about the banks, even they're in the same business, same country, and almost the same size.